a very special campaign. The beginning of the month often marks key financial activities, salary credits, and bill payments and planning expenses. But just as we plan for our expenses, it's equally important to plan for our investments. Now, to encourage this habit, SBI Mutual Fund, in collaboration with Times Network, is launching a nationwide investor awareness initiative, Bharat Nivesh, Bhetter Kar. The objective of this initiative is to promote the habit of consistent investing among Indians, helping them secure their financial future. As part of the campaign, we are observing 4th of every month as a monthly reminder to ensure that you start your mutual fund SIP or ensure your existing SIP continues. So go on and set your reminder to invest consistently and stay committed to your goals for the financial well-being of you and your loved ones. And today we are going to focus on retirement and the way you should be looking at the retirement goal, counting in all the aspects, including inflation, a very crucial villain for your retirement planning and investments. To decode all of this, I have with me Gaurav Dharmarha, National Head, Retail and Distribution Alliances, SBI Mutual Fund. Gaurav, hi, good evening and welcome to the show. Retirement, often talked about whenever we think about financial planning, and a goal which, people end up planning about almost in the end once they are done with all the financial liabilities. Now, the right way to look at retirement depends on a lot of factors. It depends on the kind of lifestyle you want to live post-retirement. Again, retirement, has a very different meaning these days. People just want to retire from a job and maybe have an income source later on. It is not restricted to the age of 60 as well. A lot of time people call it as a second inning where they want to do something out of their hobbies and maybe make money out of it. So it depends what do you understand or how do you understand retirement. But having said that, I'm going to pick up the traditional route where people want to retire at 60 and maybe have a financial portfolio or just live the kind of life they have planned. So having said that, what is the homework that one needs to do in whatever form of retirement you have decided for yourself?
Thank you, Kavita, for inviting me on this show. And I believe you have touched upon a very important topic, retirement, especially for Indians, where we are self-dependent on most of the things that we want to avail similarly the way when we were working, when we were in a profession. Be it the best healthcare, be it the best education, be it the best luxury in terms of entertainment, travel, and other things. I think one major change which has changed over the decades for retirement is earlier we used to get worried about early retirements. Someone wants to retire, say, at an age of 50, 55. I think there is another interesting area which needs a concern and a focus is that the longevity of life. Census in 2000 depicted our average age expectancy to be about 60 years. In 2023, it has already moved up to 72 years. While we say that people happily live till an age of about 80, 85 years, thanks to the better healthcare facilities, medical facilities, and better life options, better life living options. So we have to, while we are preparing for retirement, it is important for us that we are preparing for good 20-25 years of similar or better lifestyle that we have been living till now, assuming that the retirement age still remains on a range of 58 to 60, which is a pretty much a norm in our country. So while you are preparing for the next 20-25 years, the retirement corpus, as I call it, the golden years of your life, the second innings, as you rightly mentioned, need to have 2 to 3 very important focus areas. One is obviously a growth in this corpus so that it can take care of inflation, which may raise at a level of 4 to 5% year on year for the next 20-25 years. A regular cash flows to take care of your daily, monthly expenses, unexpected and expected both. And obviously, with no other income coming, this becomes a prior source for your cash flows and income during your retirement span. So obviously the safety of the portfolio is extremely important. Evaluate the risk appetite of the person, evaluate the risk capacity in terms of allocating the funds across fixed deposits, bonds, or equity markets. So basis the risk analysis, considering the volatility and the opportunities available in the market, you need to have a very balanced approach to take care of the growth, to take care of the regular cash flows, as well as safety of the portfolio of your retirement corpus.
What kind of a bucketed approach in terms of having a safe investments should one actually opt for? What is the formula for that, and what's the strategy for that?
So I call it the nest egg of retirement. You know, the funds that you have kind of garnered with your work life, your profession for over last 30, 35 years. And it is important that we segregate into 2 to 3 buckets. As I mentioned earlier, it has to be a very balanced approach, a short-term approach, say for a period of anywhere between 3 months to say a period of 1 to 2 years, which will take care of your day-to-day one-stop liquidity needs. Could be your medical needs, could be a marriage in the family, could be an education loan for your kids, or could be any other unexpected expense which is not there in your list. So funds like short-term arbitrage, bank deposits, corporate bonds, direct bonds ideally should fill in that bucket. Second bucket could be the products, the investments which can fetch you better returns than inflation, because it is important that you're able to generate returns which are better than inflation. Otherwise, inflation will slowly and steadily eat up the capital that you have saved as a part of your nest egg. So hybrid funds will play a very important role. Funds like Balance Advantage, Multi-Asset Allocation Fund will play an important role. The returns, if not used for your daily expenses towards your liquidity, can easily be parked in liquidity and can further take care of your post-retirement needs like high health insurance, right? So you really need not worry about taking a good health insurance, and the premium eventually can be paid through the returns that you generate through these investment returns which are coming out of hybrid products. The third bucket definitely would be the income bucket. How do you generate more and more income on the corpus of your retirement? So you can look at diversified equity funds. If your risk appetite and risk capacity is allowing that, you may look at investments for more than 5 to 10 years and eventually drawing systematic transfer plans out of it to take care of your regular cash flows. So diversified equity funds for the growth of your retirement corpus, hybrid funds to take care of your returns and day-to-day managing a day-to-day liquidity for you, and also beating inflation. And third, obviously, will be your liquidity corpus, which is a short-term corpus to take care of your day-to-day needs, and also taking inputs or the returns generated out of hybrids to take care of your lifestyle expenses like health insurance, other luxuries, travels, etc., etc.
All right. I think in a nutshell, very well explained. And with that, it's time up on the show as well. Thank you so much, Gaurav, for being on the show and helping our viewers navigate their retirement strategies today. Thanks.
Thank you.
And with
Thank you,
that,
Gaurav.
it's a wrap on the Money Show as well. But then I'm going to leave you with our WhatsApp number and email ID where you can keep sending us your question, and we do your life financial planning on the show as well. So do send across all your queries. Thank you so much for watching. Goodbye.